Fed launches aggressive rate cuts, melt up to continue. The Federal Reserve has opened the floodgates. After months of caution, policymakers have pivoted to rapid interest rate reductions designed to prop up an economy showing signs of fatigue. This isn't just a minor policy tweak, it's a classic all-in easing cycle. For ordinary investors, understanding why the Fed is acting so forcefully and what it usually means for stocks, bonds, gold, and crypto is essential. What aggressive cuts really mean. When the Fed cuts rates by 25 basis points, 0.25%, at a measured pace, markets take it as fine-tuning. When it slashes by 50 or 75 basis points at consecutive meetings, that signals urgency. The central bank is effectively saying credit conditions are tightening too fast, consumer spending is slowing, or unemployment is about to rise. By making borrowing cheaper, the Fed hopes to cushion the economy and avert a deep downturn. Historically, such cycles start late in the economic expansion, when growth is already rolling over. They're not random, they're part of the normal boom-bust rhythm of credit. Why markets surge anyway? Counterintuitively, the earliest stage of an aggressive easing cycle often feels great for asset prices. Lower policy rates push down yields on treasury bills and savings accounts, making cash less attractive. Cheap money fuels corporate buybacks and speculative flows into equities, housing, commodities, and digital assets. This creates a melt-up, a sharp, liquidity-driven rally even as fundamentals weaken. We saw this in 1998, 2001, 2007, and 2019. Stocks and gold initially soared on Fed easing, only to stumble later when the underlying economy slowed. Potential pitfalls: rate cuts are not a guarantee of prosperity. If recessionary forces are strong, cheaper credit can only delay, not cancel, the downturn. Corporate earnings may fall, unemployment may rise, and defaults may increase despite easy money. Another risk is inflation reigniting. If commodity prices spike because of a weaker dollar, the Fed could find itself trapped between supporting growth and restraining prices, the dreaded stagflation scenario. Investors who only look at the initial rally may be caught off guard by the volatility that follows. How savvy investors can respond. Understanding this cycle helps you plan. In the short term, easing cycles tend to benefit growth stocks, precious metals, and high beta assets like cryptocurrencies. But chasing every spike can be dangerous. This is a time to rebalance portfolios, maintain liquidity, and define your risk tolerance. Diversification across sectors and asset classes can help cushion swings if the melt-up turns into a meltdown. Bottom line. The Fed's aggressive rate cuts may extend the bull market for a while, but they're also a warning signal that economic conditions are deteriorating. Recognizing the difference between a liquidity-driven rally and a sustainable expansion can help you protect profits and stay prepared for the next phase of the cycle.